You have three different types of entities here in America. You have people, you have businesses, and then you have governments. And all three of these kinds of entities are facing their biggest debt bubbles ever. Let me start by talking about people, or as the financial world likes to call it, consumers. In August 2022, we hit a record high amount of household debt at $16.2 trillion. Then, a few months later, in November of 2022, we got an updated report which said that not only did we break a new household debt record high, but our household debt levels are growing at now the fastest rates that we have seen since 2007. The biggest contributors to these household debt levels are mortgages and credit card debt. Then if we look at businesses, in March of 2021, that's when we first hit a new record high amount of corporate debt at $10.5 trillion. This was when we were going through the pandemic and interest rates were cut to zero, so you could borrow money for cheap, and businesses were loading up on debt to help get them through the pandemic. From a business perspective, if you're able to borrow money for cheap, say 3%, and then you can invest these millions of dollars into research and development and create a new product, and now you can get a 10% or a 20% or a 200% return on your money, that's a good investment on your debt. But if you look a little bit deeper as to where this debt was used, in 2021, we saw the largest amount of corporate stock buybacks ever. Stock buybacks are not a way to put your money to work, it's a way to make your shareholders richer, which has its time and place, but when you're loading up on debt to make your shareholders richer, someone's gonna have to pay the price eventually. And today, corporations have even more debt than they did 1 year ago. Then we have our government. And in October of 2022, our national debt passed $31 trillion for the first time ever. And our national debt is not shrinking, it's growing of every second, of every day, of every month, of every year. There's two things that you really got to understand. Number one is how did we get here? And number two is what does this mean now that interest rates are rising so quickly? To understand how we got here, I want you to think about Chipotle, the restaurant. What would happen if Chipotle offered a free guac promotion where anybody who got a Chipotle bowl would get a free side of guac? Well, probably you're going to see people lined up around the store. People will be waiting for 2 hours to get some Chipotle with some free guac because people love when things are free and people love when things are cheap, and then they'd get more of it. Well, free guac works the same way as cheap debt. In the 1970s, the United States was facing a horrible inflation crisis, and in order to fight the inflation problem, the Federal Reserve Bank was forced to raise interest rates to almost 20% in the early 1980s. This is a chart showing the Federal Reserve Bank's interest rates, and after 1981 you can see that we've been in a downward interest rate cycle, meaning borrowing money has become cheaper and cheaper since the early 1980s, and after the 2008 crash you can see interest rates got cut to zero, and then we started to raise interest rates slightly after the 2008 crash, but then we started cutting interest rates again in 2019, and then after the 2020 pandemic, interest rates got slashed to zero again. So for the last 4 decades, which is longer than I've been alive, we've been in this downward interest rate cycle where interest rates have been going lower, borrowing money has become cheaper, and for the last decade and a half, we've been in a 0% interest rate environment, meaning it's been essentially free or very cheap to borrow money. That means if you're under the age of 40, you've only really experienced 0% interest rates during your working life. Over the last decade and a half, we have seen people, businesses and governments load up on cheap debt because debt has always been cheap, and over the last few years after the pandemic, we've seen people, businesses and governments load up even more aggressively on this cheap debt because cheap debt became even cheaper after the pandemic hit. Now we're seeing things change. We're seeing a complete shift in our economy and the interest rate market where interest rates are now starting to rise. We could be facing a completely different time in our economy where we won't be seeing interest rates falling, but rather a period of interest rates rising. This brings me to the second question of what does this mean going forward if interest rates are rising so quickly? And we have done a couple deep dives on interest rates on Market Briefs, which is my free financial newsletter. So if you want to stay up to date on what's happening and you don't want to read all the press releases or spend hours trying to analyze what's happening in the financial markets, Market Briefs breaks down what's happening in the markets into a fun, witty, and easy to read email that you can read in less than 5 minutes every morning. We have a whole team that's researching everything going on from the stock market to the real estate market to the economy to crypto to the global economy. That way you can get a quick breakdown and know what's happening even if you don't have a financial background. So if you haven't joined Market Briefs yet, it's completely free, and I'll put the link to how you can join Market Briefs down in the description below. The answer depends on 3 things: the person, the type of debt, and what the debt is used for. Let's go through it. Remember, there's 3 different types of people or entities that we discussed: people, businesses, and governments. So, number 1 entity is people. What are the types of debt that people are getting? Well, you have credit card debt and mortgage debt. Mortgage debt typically, now this is starting to change, but typically is a fixed rate mortgage. Please don't get an adjustable rate mortgage because that's very risky, but a fixed rate mortgage is a fixed rate debt, meaning even if interest rates go up, it's not a big deal because your payments are not going to change unless you lose your income, but it's not that big of a deal if interest rates are fluctuating if you have a fixed rate mortgage, and the use here is to buy a home. So this is for a purpose of owning something that should hopefully maintain its value over the long term and hopefully grow in value. Now, is that always the case? No, but that is kind of a better case scenario than maybe credit card debt. Entity, people, type. Credit card debt is not fixed rate debt. It's variable interest rate debt, meaning as interest rates go up, your payments go up on your credit card even if your balance isn't going up. So people who have credit card debt, and we're seeing credit card debt grow at the fastest rates ever. We have the highest amount of credit card debt ever, and people keep spending money because of inflation, and we don't want to lower our lifestyles. And the use with credit card debt isn't buying an asset that can make you money when you swipe your credit card to buy some new clothes, when you swipe your credit card to eat at a restaurant, when you swipe your credit card to go on a vacation. None of these things are going to produce more value. So this type of debt is going to cause a lot of problems. If people keep spending money, you build up this huge balance of credit card debt, and now the cost to service this credit card debt is going up because interest rates keep rising. And as interest rates continue to rise even faster, well, now your payments on your credit card debt is going to continue to rise. What is that going to do to the economy? Well, if people have to spend more money to pay down their credit card than they did before, that means they're going to have less money to go to Chipotle. They're going to have less money to go to Amazon. They're going to have less money to go to Apple, to go to Lululemon, to go anywhere else and shop, because more of your money is going to pay off your previous purchases and you have less money to spend. Now, from an economic level, how does our economy work? Our economy works on spending. The more money you spend, the more money somebody else makes. The more money you spend at Chipotle, the more money Chipotle makes, the more money Chipotle has to open more stores and hire more people and invest in better technologies. And so this is where you have to understand that if interest rates continue to go up and if people have this absurdly high amount of credit card debt, that's going to hurt the growth of the economy because people's spending ability will slow down. Then we can look at corporations and businesses. Entity, business. Now, what is the type of debt? Well, corporations don't typically get a 30-year mortgage. What they're getting is short-term debt. What you can see with this chart is that short-term corporate debt is at the highest levels that we have seen in 10 years. Now, not all corporate debt is short-term, meaning it's a 5-year term. But some corporate debt is a 10-year, some is 15-year, but a big chunk of corporate debt is short-term debt, which means the interest rate that a corporation has to pay is going to readjust every year, every 2 years, or every 5 years, or something within that range. And so now, if a corporation loaded up on debt in 2020 and 2021, well, that means in a couple of years or a few years after loading up on this debt, their payments are going to readjust. And when your payments readjust at an interest rate 2 to 3 times higher than what you originally got it at, your payments to service this debt are also going to go up very high. So you have corporations that have not a variable interest rate debt, but a short-term interest rate debt that readjusts every few years. And what was the use? Well, some corporations use this money to actually grow their company, but other corporations used this debt to just buy back their own stock. And if all you did was load up on a whole bunch of debt to buy back your own stock, well, now there's going to be a lot of pressure from your shareholders to say, now our share price is very high. We're going to need bigger profits. We're going to need bigger revenues to justify this higher share price. And now you also have higher expenses because more of your revenue is going to be used to pay down your debt instead of actually growing your revenue and growing your profits. And this is coming at a time when our economy is also slowing because people just have less ability to spend. The cost of everything has gone up so high. So you can start to see that this corporate debt bubble is going to start to unravel in the next few years as people start to see the impacts of all this corporate debt, especially if the economy is slowing down with it. And then we have the government national debt. Now, just like corporate debt, our national debt typically isn't a 30-year fixed rate term. Our most popular treasury bonds, aka loans to the government, are 5 years or less. And over the last couple of years, we have seen a balloon in our national debt. Not to mention all the debt that our government took on over the last decade, but now, over the next couple of years, as we start to see more and more of our national debt start to readjust, the interest payments on our national debt is going to also increase. Now, how does the government make money? Well, they tax you, they tax me, they tax people when they go to work. And the more money you make, the more a business makes, the more investors make, the more tax dollars that the government makes. Well, if the government has higher expenses, not because they're investing more money, but because their debt payments are going up, they're going to need more money just to service their debt payments. To put that in perspective, it's estimated that between 2025 and 2026, which is just a few years away, our national debt payments, the interest payments on our national debt, is expected to surpass our total military budget spending. So we're going to be spending more money just to pay off our debt than we're going to be spending for our entire military force, our entire army, our entire defense spending is going to be less than how much you're spending just to pay off our debt. Now, how is the government going to cover and service these higher payments? Well, they're going to need more tax dollars. How do you get more tax dollars? Well, you hope that the economy is growing so people make more money, so business owners make more money, and so investors make more money. That way the government can generate more tax dollars. But if we think about what's happening with our economy and everything that I just discussed, well, we're seeing an economic slowdown. People are losing their jobs. People are seeing smaller incomes. And so if business owners are making smaller profits, and if people are losing their jobs, that means the government would be making less money. And if the government is making less money but has higher expenses, they're going to have to raise taxes, meaning you are facing high inflation. You're already facing higher costs. And the government now, because of all their higher debt costs, may be forced to raise your taxes as a way to now subsidize their higher payments, which means the government would have to squeeze more pennies from people and business owners and investors to get more dollars to pay off their taxes, which leaves business owners and people with less dollars to now just service and continue surviving in the economy. So you can start to see this debt burden is going to be a problem that's going to continue to unravel as interest rates continue to get higher, because we haven't seen the full effect of interest rates where they are today. It takes time for these higher interest rates to get absorbed into the economy, and over the next 12 to 24 months, we're going to see a lot of changes happen in our economy with businesses, with people, with the government, because more and more debt is going to readjust, and the cost of these higher debt payments is going to start trickling its way through the economy. This is why you want to be financially educated. Start making smarter decisions with your money today, because there's going to be pain ahead because of all of this debt burden, and this is where you want to be smart, be prepared, and be educated. That way you can take advantage of opportunities that happen because of this debt burden. Would you rather look rich or be rich? And you might say, of course I'd rather be rich. But if your lifestyle doesn't align with the words that you say, well, somebody's getting rich, it's just not you. If you own Gucci or Louis Vuitton or a Beamer or a Benz or a Rolex, but you don't own an investment portfolio worth at least as